Today we're going to talk about the top 5 to 10 dividend companies that I like best. I was going to get into my dividend portfolio and I'll explain why I'm just going over the top 5 to 10 as we move along in the video. So it should be a really interesting video. I love these companies and we'll go from there. So my name is Adam Kahn. For those of you who don't know me, today is Saturday. I think it's August 9th. The year's just flying by, and when you get old, it's like you lose track of some of that stuff. Anyway, I hope everybody's having a good weekend. I hope everybody's doing well. Today I'm going to talk about some of my top favorite dividend stocks and explain what I like about them, what I don't like about them. The first one I'm going to get into is probably one of the most controversial, mainly because their expense ratio is pretty high, or what they charge in order to have it, and it's a fund. But I have a decent sized position in this one. I'll try to be, disclaimer type of things. But the first one I pick, its ticker symbol is PFFA. And forgive me if I pronounce it wrong or get the name wrong. It's like InfraCap something something fund. See how well I prepared and how I'm going to get into it. They invest in preferred stock. Part of what I like about this fund is a couple fold. One is I haven't taken the time to research it preferred stock enough to go through and pick the ones I want to own. So it's a way of me being invested in that space and kind of diversifying a bit and just having it in a fund instead of me having to find out about a new area of expertise. Not that I consider myself expertise, I just say. Anyway, what I like about the fund, it pays a little over, I guess it's over a 9% yield. I was about to say just under a 10%, but then my brain kind of said it the wrong way. And they pay monthly. I like both of those things. They don't really matter all that much. You're not going to do that much better by getting paid monthly, but I'm assuming, like most people, I live monthly. So it's kind of nice to, when I start using that dividends, to receive those payments monthly. Right now, I'm set up where it's in a drip, but primarily I want it to grow as much as possible over the next however many years, so that when I do start taking those distributions, that it's bigger and bigger and it comes in monthly and it's kind of a nice payment. Again, the negative is they have a large expense that, I think it's like 1.75%. But my real attitude, and this goes for everything, not just this, if they can make enough to pay their employees and run their company and do well, and I can do well at the same time, I'm really okay with that. I'm not going to nitpick a company that they charge too much. And, imagine you can make 30% return on an investment. Do you really care what the company that's helping you with it is making? And that's kind of how I feel about PFFA. If the expense ratio is high, so be it. I've been in it for years. They've been making their payments. I haven't had much of a scare with it. It hasn't changed a whole lot. It seems to be pretty consistent. So, at least for me, that gives some trust in it. Now, I have gotten some people who've made some comments on it that have been negative, and some of them have made some really good points. So I get that there's some things that people don't like about it. I was just sharing what I do. Excuse me. Now, the next one, so I guess we're up to number two. I'll try to keep track to know how many I talk about. The next one I'm going to mention is one I picked up recently, which is Conagra Foods. Now, talk about a boring stock that has some things going on right now that are a little bit scary. So I feel like, buy when the news is bad. And I don't expect this to have any huge returns, but they're paying over a 7% dividend currently. They make plenty of money to be able to pay that dividend. Their projections are a worse year next year and still plenty of money to be able to pay the dividend, and then beginning to grow the year after. Now, keep in mind projections are like, looking in a crystal ball. I bought a little crystal ball on Amazon. But projections are trying to look at a crystal ball to determine the future, and who knows if they're accurate or not. But Conagra's been around a really long time. I owned a restaurant for a while, and man, they got so many products, and there's so many things that we eat, and they have such a big hold on the space. I think they'll be just fine. I don't think they're going to have to cut the dividend. They had a bit of turmoil recently, I mean, over the past couple of years, which has driven the stock price down, which is why the yield is as high as it is. But I think that creates opportunity if it's just something that you're looking for a dividend to pay for a long time. Now, I want to make a comment about some of the funds that I don't have. I mean, I have a tiny bit, but I don't count them. I just have a tiny bit more to learn about them so I can talk about them on the channel a bit more than I really want to own them. And I'm going to tell you why I don't like the yield max funds and the ones who work in this way. And I'm not going to go into it as significantly as I did in others, but they are designed to lose value over time. The sales pitch from the guy who runs the fund, Jay Piskacek or what, I don't know his last name, but he's like slick used car salesman. Forgive me. Is that yes, it's going to go down over time. So the way to you know counter that is by reinvesting your dividends. Now that's really self-serving for him. Of course, he wants you to reinvest your dividends. He wants you to put as much in the fund as possible. But I want you to understand the whole sales pitch of these things is you have these huge dividends so that you can retire. And then the follow up is you have to put those back into dividend reinvestment in order to not lose your value in the companies. And they're designed to continue to go down in value. Well, if they continue to, sorry, bug, if they continue to go down in value over time and eventually get to zero, and you're continuing to funnel money into them, even though you're possibly growing the amount of shares, unless they don't continue to erode, then what good is it? I really don't love these funds. Anyway, that's a little off topic. Conagra's number two that I really like. Number three that I really like is Pfizer. I know there are a lot of people who don't like it. And it's also possible during this administration for the next 3 years, they could go through a really rough span. It's more that similar to Conagra, they're paying a 7% yield. They make plenty of money to be able to pay for it. And even if they end up having to cut what they charge on the medicine that they sell, which I think is actually a good thing, their margins and what they're making right now seem to be just fine to be able to pay the dividend and potentially continue to grow over time. Their past few quarters have actually been pretty good, and I've seen the stock pop up and then sell off a bit. Eventually, if the earnings continue to be good, that'll catch itself and it'll start to drift higher. What I hope for in a company like Pfizer and similar with Conagra is that I fall asleep for the next 8 or 10 years. I receive my 7% dividend and I wake up and maybe Pfizer is trading $60 out in 10 years. I haven't crushed it in the performance of the stock. Hopefully I get my dividend and they're able to raise that dividend a tiny bit each year, so I'm getting a little more and a little more. As the price gets to that higher price, sure, maybe the dividend only shows as 3% at that time in 10 years, but hopefully I'm getting a larger dollar amount than I was getting now. And if I base it on my purchase price, maybe I'm getting a 10% dividend on what I spent and not where it's actually trading. And it's a nice check coming in. I don't expect companies like Conagra or Pfizer to really grow a whole lot because, for one, by giving out that much money for their dividend, they're not looking to continue to invest in their business to grow at the rate of some other things. So, if I can receive those dividends, I'm good with that. I'm not looking for a whole lot more. It also gives me opportunity to do my little disclaimer of, oh my goodness, of don't, try to do a video while you're coughing. But, please don't listen to me. This is just entertainment purposes only. When you're making your financial decisions, you need to do your own research and reach out to a financial advisor or talk to your lawyers or accountants or whomever it is that guides you in that way. You shouldn't be listening to me or anybody else on YouTube for these decisions. I hope you enjoy the content. I hope it, helps you with your thought process and whatever else. But you and I, or whoever it is, are really in a different spot in our lives and what we invest in and how we do things. So what makes sense for me may not make sense for you. That being said, number four on my list, one I've talked about a bunch of times, which is Target. What I like about Target is so many things. One being that they pay a 4.5% dividend that, if I remember correctly, is only using like 35% of their free cash flow. So they're crushing it in terms of that. It gives them tons of room to raise the dividend if they want to. It gives them tons of room to buy back stock if they want to. It gives them a lot of opportunity, and they're probably using that money to invest in the company, which is actually finally looking like it's bottomed out in terms of its earnings getting worse and has potential to start growing again, even with those terrible things of the earnings getting worse and everything else. They have a PE. God, I didn't even look at it. I wish I had, but I think it's like 12 for a company that's growing much quicker than Walmart is and has potential to do really well and has a good balance of being able to pay a dividend and grow all at the same time. That's what I really like about Target. I also love all the negative news that's come out on it over the past couple years. They were woke, they're not woke, they had the robberies in the stores, they did this, they had to close stores, and everybody hates Walmart or Target. Sorry, Freudian slip. Well, I really like when people hate a company like that because with time, things pass. People forget all those things. When you go out 2, 3, 4, 5 years, nobody even remembers. And for that guy who's going to comment, like, I'll remember, I'll never shop there again, good for you. But as a whole, no, people don't. The same thing happened with Chipotle. I want to say 5 years ago. Maybe it was more recent, maybe it was longer. When they had problems, they had rodents coming in the stores, there was tainted food, so on and so forth. And the stock just collapsed. And I picked it up and I screwed up the trade. I really kicked myself for it. And then, as people forgot over the next year or two, earnings went right back to normal. They continued to grow as if they were prior to all this. And even my wife, who said, I'll never go to Chipotle again, was probably eating there 6 months or 8 months later. And when I said something, kind of shrugged and was like, oh, yeah, I forgot about that. Like, that's typical. People don't hold on to these things for more than a year or two, and then earnings can go back to normal how they were before. And for a company like Target, who's giving you a high dividend, still growing, has a good position in that field, like, I don't picture them Sears. I don't see them really going out of business. And the other thing I like is they do really well online and they're beginning to compete with, like, I don't want to say they're competing with Amazon, but they're taking from their playbook where you can buy and they're going to work on delivering it to you same day. And they're even starting to work, from what I understand. I haven't seen them say it, I just know some people who've mentioned this to me. They're working on a similar platform that both Amazon and Walmart use, where if you sell something and you want to go onto their platform and sell through Target, you'll be able to, with them taking a percentage and handling the distribution and everything else. These are really good platforms. They don't have to put up the capital for the products they're buying because the person selling them is. They typically will have a warehouse that manages the shipping and the returns and things like that. They do allow customers to use that, but I think they hold back some of the funds when they do that in case the returns aren't going the way that the Target, because it puts their name on it, would hope returns go. Um, it's a cool structure. I think they're going to start implementing that. I don't know how long it'll take, but I think it's a way for them to continue to grow their business. Now, number 5 on the list is really the only one I am actively adding shares to right now. I've talked about it in other videos, which is United Healthcare. I think with all the negative news, it's like bad news, good company. I think it's really undervalued. Now, this one has some real risk with it, which is what happens when things become undervalued. So feel free to tell me what's going on, why you think it'll go badly. But it started with the shooting and the CEO being killed by Luigi, oh my God, Mangione, I think, and it coming out that maybe they're not doing things the way that they should be. Now, we all know healthcare is a really tough thing, and we all kind of have an idea that they fight us tooth and nail when it comes to paying for things, but they're happy to collect our monthly payments. I'm not advocating that I think these are great companies in terms of their morals or their ethics or things like that. I'm really just getting into the investment side of things. So people already hate the company. It was trading like $650 a share. I haven't looked, I'm just telling you approximately. If feel free to put in the comments where it actually was if I'm off a little bit. As the stock started to tumble to the 500s, got below 500, was in the high 400s, and then they had a not so great quarter and it crumbled to 400-ish. And then there were rumors about the Department of Justice looking into things, and it really started to tumble further, as well as having another bad quarter, and it collapsed down to like $250 a share. But as it did, all the people on the board, as well as people in the government, started buying into the stock. The bad news has continued to come out. It became official that the Department of Justice is digging into them for bad practices for Medicare and Medicaid. It's pushed it back down to that $250 level, in fact, 240 and below for a little bit after it had rallied to 300. But it's not like any of these people are going in and selling the company, which tells me at the end of the bad news, it should be okay. When all the people on the board are buying stock and the people in the Senate and the Congress are buying it as well, I think they're aware that they're not going to put them out of business. And I also think they're too big to fail. Now, I'm guessing they were really doing some things wrong. I think what's going to happen with the Department of Justice is it is going to take time to sort it out. So you're going to continue to see negative things in the news. This is really similar to Boeing when they had the planes crash and the CEO was using the company jets for his own personal use, and people who were whistleblowers were dying about the things going on. Like, negative things come out on good companies, and hopefully that creates opportunity to be able to buy them at a discounted price. Now, Boeing could go back down. Again, none of this is financial advice. Markets are markets. It's hard to predict. You just don't know. But similar in terms of what I think in terms of the negativity on United Health is pretty good and pretty weighing and has driven the stock price down on top of everybody wanting to hate them because they're in such a bad industry that's really hard to deal with because your goal in that industry is to maximize profits, and the consumer, and it makes sense, would hope that your goal is to do what's best and help people stay healthy. Well, those are counterintuitive things, so of course they're going to have problems of what works and what doesn't work. I mean, if your goal is to maximize profits and people want to get paid for surgeries and issues and whatever else, and you're constantly denying it, trying to get your profits up, like, that sucks. And people are going to hate that company. So everybody kind of sides with that kid who killed the CEO. But man, that's not okay either. Like, you can't just go out there and shoot people who run companies because you disagree with what they do. I mean, these guys have families and everything else. It doesn't mean they're potentially immoral. They're probably just doing the best they can for the job they're supposed to do. Anyway, that's just my little. Either way, United Health is the largest healthcare provider. I don't think a whole lot of the companies that are set up with them are making changes to their employee plans because of whatever's going on in the news. Even if they have too many people getting procedures and whatever else that's been hurting their earnings for a little bit, they'll have to raise their premiums, they'll have to change things, and I think they'll continue to drive those earnings. Even with all of this bad stuff, over the last 12 months, they made $16 a share, trading at $250. That puts them at like a 15 PE on a company that's been raising their dividend at 10% or higher per year and growing those earnings typically. So if they get back on track and they're able to raise those premiums a bit and push those earnings again and raise the dividend, I mean, you're getting the best dividend yield that you've gotten pretty much ever, as far as I know. I think it creates a great opportunity. That's my stock number 5. It's the only one, like I said, I've been currently investing in. I just know it could have a really rough couple of years while it works through this stuff. My time horizon is 5 years out or longer. Number 6 on the list is Cisco, not Cisco Foods, the Cisco CSCO Cisco, the technology company. What do I love about Cisco? I love that nobody talks about them. They made their highs back in 1999 or 2000 when there was that internet boom, and they haven't gotten there since. So I've been watching the stock slowly creep higher while nobody pays attention or talks about it. Now, this is just my trading background and how things move and what tends to happen, not an analytics on the earnings and the company and their growth potential or anything else. I have noticed their earnings reports and their quarterlies have been good, but I don't want this to be confused with what I'm noticing about it as a dividend payer and what I like about it. Also, disclaimer, I do have a position in Cisco and I like the company. So they've been creeping higher. And as a trader, if they actually breach those old highs, especially after, man, 25 years, when that typically happens, the upside potential, like it's supposed to double from there at a minimum. So what I've loved is it just keeps creeping and nobody's paying attention. In the meantime, they're paying a 2.5, maybe a 3% dividend. So it's nothing like blockbuster. I still like those dividend payments, but nobody pays attention. And I'm guessing they still have a lot of customers. They're probably involved in the AI development, and they're still doing all the things they do to continue to grow their business. So if it breaches those old highs, I think they really skyrocket. Similar to like if you look back, that's what happened with Microsoft. I think it took 17 years before they finally breached their old highs. And since then, they've taken off like a rocket ship. Like nobody's buying Cisco. I don't see it as this thing that people are constantly talking about on CNBC is this great company that's going to continue to beat this and do that and whatever else. So until it gets to that point, it seems fairly valued to me. So if they continue to grow earnings and do well real quietly and get past those old highs, I think you end up in a great position until it gets overbought. And I think it's probably got another 5 or 10 years until that happens. Number 7 on my list. Sorry, I'm trying to sound like what's his name? Briggs? Is that the guy who does like, places to live? And I like his videos, very entertaining. Anyway, number 7, Chevron. Great company. You could substitute Exxon in the name as well. I'm fine with either. The only reason I say Chevron is it's the one I own. I used to own both. I kind of, I bought them to have money in that space, and they both paid great dividends at the time. The dividend now is good, but not as great. And what happened is I had a tax event, so I could take profits against some losses, and I figure they're pretty much the same thing. And I took a look, and Exxon was paying a lower dividend yield than what Chevron was. So I chose to sell the Exxon, have the profits in that, and move the rest into Chevron. It was not because I like Chevron better or worse or whatever. I see them as really similar. I don't see oil and gas going away anytime soon, and they are big players. I understand the rotation into electric vehicles, but myself, who has only electric vehicles in the home, I still drive around and see an awful lot of gas stations, and there's still cars going in there filling up. On top of the fact that they're not only dealing with cars. And if things transition, I'm guessing they've put themselves in a position that maybe they can deal with the oil and turning it into what's needed to be able to fill tankers or army trucks or planes or whatever it is that's needed. In fact, I think I see their trucks in the airport, so they probably are already in those spaces. So I don't really see that going out of business anytime soon. Chevron is paying over a 4% dividend last I looked. They continue to grow their earnings. In fact, they just bought somebody out, which I'm guessing is really going to help things go. Um, and these guys are just huge. When I drive around Las Vegas, if I had a gas vehicle still, it's pretty hard to avoid Chevron for any reason. They're the majority of what I see. I just don't see that changing. Their earnings are pretty stable, and I'm guessing they're pretty fairly priced most of the time. If it got to the point where I saw people super exuberant over oil and gas again, well, maybe it would be an opportunity to get out. Or if things got really bad again, maybe it's an opportunity to buy more. I just like getting the 4% dividend. I feel like it's pretty safe. They're not using all of their income to be able to pay it. And again, I don't see the electric revolution happening faster than what people think, no matter what Elon Musk or any of the others say. So, number 8, and the reason my analysis and my comments are getting quicker and quicker is as I get further into them, I- I have a less of a conviction to them. It's just they're dividenders. Most of them I have in my account, but this next one, T. Rowe Price, I really like the company. I thought it was a bargain when it dropped to whatever the lows were. Now that it's popped up, I think about $20 from where it was. I don't see it as big a bargain, but I think they're in a good space. They're continuing to grow. I don't have a lot that I just love about the company, but they're paying a 4.5% yield. And as I started rotating out of some of the growth stocks into some of the dividend payers so that there was a little less risk in the portfolio, I liked what I was reading about T. Rowe Price. In terms of their free cash flow to what they're paying out in the dividend, it was really reasonable, which gave me a comfort level that if things slowed down and their business wasn't doing as well, that they'll be able to afford to continue to pay that dividend. And I was buying it on being able to receive the dividend payments, not my hope for the company to grow or do better over time. I've been lucky with when I started picking it up, so yay. But I didn't pick up a whole ton, so it's really not that big a deal. And again, I'm just hoping that they're in the position to be able to pay that dividend. So I picked up them. Number 9, I'll jump right to it on the list. A similar type of explanation is Prudential. Also paying a little bit lower than T. Rowe Price, but I think 4.25, maybe 4.5% yield. And similarly, since they're on the insurance side of things, I felt like no matter if there's a slowdown or not, that they're going to continue to have the cash flow coming in. They'll be able to pay their bills and pay the dividend and should be just fine no matter what goes on in the economy. So that's what I liked about both T. Rowe Price and Prudential. Not companies I want to own for the next 40 years. It's not like I'm buying them the way I buy Amazon or some of the others that I just think they're the best of the best. I was buying these to take some risk off the table, have some dividend payments coming in that hopefully I can rely on as I move closer to retirement, and have a little bit of safety that if there's a market correction, hopefully, and sometimes this is not the case, they don't fall as far as the other stuff as the correction comes around. Now, as a little asterisk, I don't think we're near a correction. I think the fact that people are really concerned about it and think one's coming is why we don't have one coming. And I think they're pushing a lot of money into the economy that odds are the stocks continue to go higher for a while until money's been spent and people are, too stretched and whatever else. Again, not financial advice. You need to do your own research. And let me go take a look at my list so I can come up with numbers. And number 10, I actually changed what I was going to talk about last minute as I hit the start button because I didn't want to say it's the one I'm least convicted on. I love Google. It's an excuse that they started paying a dividend because the dividend is like point 0 whatever. And I'll put Meta in this category too. These are really growth stocks. But Google, to me, of the Magnificent Seven, is still undervalued, even though it finally breached 200. They are so well diversified. They keep talking about ChatGPT is going to crush their search, but every quarter their search is continuing to grow at like a 10% plus rate. And what's his name? The CEO. I can't think of it. You guys can put it in the comments. But he keeps saying the same thing, which is search is continuing to grow. He sees room for everybody in the space. Their Gemini is excuse me, helping the search continue to grow, and they're crushing it. So while everybody's talking about how search is dying, they're continuing to grow and do just fine. You then put on there YouTube, where we all watch these videos. I'm on there all the time. I don't go to TV anymore. I do watch Netflix and I use Amazon Prime from time to time. And I even use what comes with the Samsung TV, but I primarily go to YouTube first for my content watching. I don't guess it's not TV anymore. And that's where my son goes as well, who's 13, 14 years old. And my attitude is if all the 14 and 13 and 12-year-olds are going to YouTube, it's got a long lifespan. They're going to continue until they're 40 or 50 years old using these platforms. So YouTube's going to be around a long time. The advertising on there continues to grow. They're also getting into web servicing, like Amazon Web Servicing, and that's continuing to grow. And then you have what I consider like a call option with Waymo. What I mean by that is I don't think there's any value in Google stock factoring for Waymo. The opposite of what's going on at Tesla. So Tesla has put this huge valuation on robo taxis and robo cops and whatever else that's factored into their stock price today for their hope of their future. Google, on the other hand, has Waymo, which is growing at an extremely fast pace, that they value at pretty much zero. So if that becomes something, they could crush it and that value would be added onto the Google stock. So I think that creates a great option. I think it's a great opportunity, and their earnings crush it. Even with the move up over 200, it is still only 21 times current valuation and below 20 for future earnings. I think that's an unbelievable opportunity for a company as big as Google growing at the rate that it's growing. And the best value I still see on the Mag 7. So that's number 10. I was going to talk about Stanley Black and Decker, but it's similar to Prudential and T. Rowe Price that pays a dividend, looks like it's in the position to be able to pay it. I don't see that having too much trouble no matter what goes on in the economy because I think they sell a lot of tools and do just fine. Why did I not put in like an SCHD or something like that? Like those are great ETFs, but no reason to pick stocks if you're getting into an SCHD. In fact, for those of you who don't want to think about any of this, and I doubt you've gotten this far into the video if you don't like this stuff, there is no reason not to have an account with VOO, QQQM, and SCHD and be done with it. In fact, the stock account that I have for my son is VOO, QQQM, and then I have a little Meta and Spotify because he wanted to pick those. But I've told him if he doesn't get into investing and doesn't find it interesting, just put it in VOO and QQQM and don't think about it. Go do your job and continue to invest. And they're a way of being invested in the market without having to pay too much attention. Anyway, again, happy Saturday. I'm going to go work on editing it and trying to get it posted in the next few hours and enjoy the rest of your day. Oh, before I forget, if you haven't already, hit that subscribe button, smash the like button. By all means, make tons of comments in the comment section. I like to have the conversations. I like going back and forth, and it's pretty cool to me. I love YouTube site. Have a good day.